Hello, greetings, and welcome to Dividend Blasters. This is our 17th video, and the topic today is retiring off SCHD with millions of dollars, the power of the drip. You know, I've talked about the power of the drip in previous videos. The drip is dividend reinvestment planning, and it's really taking advantage of the wonderful thing known as compounded interest plus a continued disciplined approach to investing for the long term. I'm going to get into that in a little bit, and I'm going to talk to you a little bit about what SCHD is. Folks that like me that invest in dividend growth investments, we know what SCHD is, but not everybody is. There may be some new people to the channel. I'm going to provide a little bit of background on this wonderful ETF known as SCHD. It's formerly called the Schwab U.S. Dividend Equity ETF. SCHD is its ticker symbol. I'm going to give a little bit of background on it so we're all starting from the same page. Talk a little bit about its beginning, what some of the holdings are, what its purpose is, and then I'm going to pivot to an online calculator that I have access to. It's not free, but it's a wonderful tool. It replicates a lot of things that I've done for you in Excel in the past, but it's much quicker and it's very efficient. And I get very excited when I go to it. Quick disclaimer, I am not a financial advisor. The purpose here is for information and education. This video reflects my own personal opinions. So please, before you make any major financial or investment decisions, consult a financial advisor and do your own research and due diligence before making any major decisions. Now, having said that, I've been an independent investor for more than 30 years. I've invested in stocks, ETFs, real estate, precious metals, cryptocurrencies, you name it. However, I do consult my own licensed professional financial advisor each and every time before I make a major financial or investment decision. Folks, take advantage of them. Do the prudent thing. That's what they're there for. A little bit of high-level background on SCHD. It's an ETF or an exchange-traded fund. Like all ETFs, they trade just like a stock. Managed by Charles Schwab, and it invests solely in dividend-paying stocks. And specifically, it focuses on the stocks that are in the Dow Jones U.S. Dividend 100 Index. These are the very best dividend-paying stocks in the world. I have the website right here. You can go to it. I am also going to pivot briefly to the site so you can see it yourself. SCHD was formed back in 2011, so they've been around a while. Before I go ahead and pivot to the background information on SCHD and on the index and the online calculator, let me thank you for coming to the video, and I would kindly ask, give us a like and subscribe to our channel. It's a great help to us. And share the video with a friend or a family member you feel may find this interesting or benefit from it. All right, we're going to go ahead and pivot. Okay, we're going to go ahead and pivot to my Seeking Alpha page for SCHD, and I am a subscriber to Seeking Alpha, so I have a lot of good detail on all my investments, and I want to share this with you. Great articles, great analysis. Glad to be a subscriber. Here we're looking at SCHD. It closed at $70.51 yesterday, Friday, March 17th. This here on the right, I'm going to show you, has some metrics for the 52-week price range, the day range. The expense ratio, this is a good metric on how we compare ETFs. And I will tell you that as far as ETFs go, this is a great expense ratio. And what does this mean? This means for every investor, you invest $10,000, you're going to pay $6 a year. That is very reasonable, very fair. I've seen other ETFs that have expense ratios of 0.35% and higher. So this is good. It's a quarterly dividend-paying ETF, dollarized. The yield is 3.63%. That is a decent yield. I like the 2 to 3% range for dividend growth investments. This is a little higher. Dollarized, it's $2.56. For ETFs, there's no market cap. Doesn't make sense. So we look at assets under management, a little under $45 billion. Looking at the chart, you can look at the 1-year price return. I like to look at the 5 years because the last year has been kind of sucky. You can see that SCHD has returned about a 42% price return over the last 5 years. That is pretty decent. And I am going to actually go right to dividends. This is a wonderful tab right here. You can see Seeking Alpha gives SCHD a grade of A+. And here is how it's broken out. By dividend yield, dividend growth rate for the last 12 months, 3-year CAGR, 5-year CAGR, 10-year CAGR. I like the 5-year CAGR, really. I think that this is a good metric to speak to how the company is increasing their dividend yield annually. They've been increasing for the last 10 years. So these are wonderful, wonderful grades. Let's scroll down a little. This here is just a summary of what I just said. And let's go up. So that's the dividend scorecard. Let's look at the dividend yield. And here it is for the last 5 years. This is the 3.63%. And we can actually do a comparison. Let's do a comparison with an index fund that tracks the S&P 500. And I like VOO as our candidate for this. VOO is a wonderful ETF, but you can see that the dividend yield is less because the S&P 500 is made up of stocks that are not all dividend growth stocks. They are growth stocks. Some of them don't pay dividends at all. So that's where the difference is going to come in. So you can see that if you're looking at investing in dividends for the long term, SCHD is superior to the S&P 500. So if you want to grow your holdings through dividends, SCHD right there is a way to look at it. And as I've said before, growing wealth over the long term, you need more than price appreciation. You need dividend growth. It's really a key component. And you need time. As I've mentioned before, investing in the moonshot is great, but it's not easy. This is more of a rational, reasonable method to get there, if you will. Yield on cost for SCHD for the last 5 years is 5.14%. This metric actually makes a little more sense when you're looking more closely at your own portfolio, and I can show you that when we get to the calculator. And here is the dividend yield history. Not too much here, except that you can see that it's going up. Look at the yield here, the average yield. It's going up each and every year, if you will. I'm going to scroll here, and let's look at dividend growth. This is a nice tab right here. And you can see that the annual growth rate continues to grow significantly. The growth rate doesn't need to increase each and every year from the previous growth rate, as long as it's growing. And you can see, however, that each and every year they're increasing their dividend yield by 12%, 11%, 12%, 13%, 14%, 15%. This is a winning combination. This is a good story that they're telling, if you will. What I would like to do is go to charting. And this is what I like. And I want to go back to comparing S&P or SCHD to the S&P 500. So here you go. I already have it set up. This is for 1 year. Let's go for 5 years. So for price return, it's fairly close. I would say that SCHD price return is slightly below the S&P 500, about 2.5 percentage points below. It's not bad. It's about the same. But we don't invest in SCHD solely for price return. We want that dividend, and we want that growing dividend. That's the story. So how do we tell how we're doing? We have to look at the total return. Okay, because the total return incorporates price appreciation and the dividend. So take a look here. All of a sudden, we're pulling away. For 5 years, we're at 65%, almost 66%. The S&P is at 57.8 or 4%. So this is where it starts to pull ahead. All right, I'm going to pivot now to the Dow Jones U.S. Dividend 100 Index. This is a public site. You can go there. You can read all about what they, what makes up the index here. You can actually look at the holdings. Here they are. Broadcom gives the ticker symbol. Verizon, Cisco, Texas Instruments. This is all also in SCHD, but I wanted to show you where they are on this site. But you know what? What you can do is you can go to the back to SCHD, and you can actually, let's do that real quick. I'm going to pivot. I do like to pivot. You can actually see the weightings by sector and by company. And so here they are, Broadcom, Cisco, Texas Instruments. And what you see here is there is not one holding that's more than 5.23%. So they broadly diversify by holding. You see Coke and Pepsi and Home Depot and Lockheed Martin and Merck. And here it is by sector. So it's a little bit heavier in the financials and then in technology, and it goes down when you start to get into industrials a little bit with Lockheed Martin, and then consumer and healthcare. So that's specific to SCHD, but I wanted to show you where they're drawing from. These are the companies that they're drawing from. These are wonderful companies. These are marquee companies. So you could rest assured that your investment is safe when you invest in SCHD. And you know what? This index, these companies have to perform. If they don't continually increase their dividend, they get kicked out of the index. So another reason to recognize that your investment is going to be fairly safe. Now I'm going to go to the calculator that I've been talking about, and I subscribe to a service provider called MarketBeat. It's another wonderful resource, and I love the calculators. And what you do is you go right here to their calculators. It's under calendars, and I'm not going to do that. But let's just type in SCHD. You can see that it pulls it right up. I'm already there, but it pulls it right up. We'll click on it. Let's let it spool for a second here. And we'll wait a second or two for our calculator to come up. And here it is. Okay, so individual stock, yes, let's just say it is. It's a quarterly distribution. Yes, we are going to drip. We're going to reinvest every single dollar of dividends back into our holdings. Now, the share price is $70.51. I'm going to go with something a little bit more modest for our initial investment. I'm going to say 71 shares. That'll put us at a little over $5,000. I've already done the math. You can do it. And annual contribution, let's go less than $7,000. Let's go $6,000. Okay, so $500 a month is about $6,000 a year, right? $500 a month is $125 a week. We got the dividend tax rate, so 15% for qualified dividends. That's for us that are going to hold them for the long term. This is reasonable. The dividend yield to start, 3.4%. Yes, We saw in Seeking Alpha it was 3.63%. This here is very low. They pop in, I don't know why, a 3% CAGR for the dividend, yield, all right, a CAGR or the dividend growth rate, when in fact theirs was over 13%. Let's be conservative, but let's be a little bit more realistic. I'm going to basically say 12%. I think that is very fair. And let's say that the price appreciation is 3%. I think that's reasonable to expect an annual price appreciation of 3%. Some years it'll go up. Some years, like last year, it'll go down. Overall, it'll go up on average to 3%. That's my assumption. That's reasonable. Let's take a look at 30 years, and we're going to do a calculation. And when I do this, you'll be able to see the progress over 10, 20, 30 years. But let's do that calculation. And, I've done this in Excel for you, but I like this calculator. It is quick, it's efficient, and I can get done quicker. And then I can go out and play golf or spend time with my family, which is really what it's all about, isn't it? All right. These were the parameters we put in. Let's scroll down. What you have here are some nice charts, and then there's a table. I'm going to quickly show you the charts, and then I'll go to the table. So what's your portfolio going to be worth doing this? So starting out with $5,000 and then $6,000 every year, and then you're getting price appreciation of 3% a year with a 3.4% dividend yield, and you're increasing that yield by 12% every year. After 30 years, you're going to have over $6 million. Now, I like that. Let's go back. What's it going to be at 20 years? Well, not nearly as much. Still pretty good, $465,000. 10 years, you'll have about $97,000. So you see what's happening. You're going to increase it, and you're going to start to increase at a increasing rate. And this is the dividend snowball. This is dividend investing at its finest. Let's scroll down a little. So this is dividend income. Okay, this is what you're going to make each and every year. So that first year, you're going to make $170, and then it's going to go up second year to $417. But let's look what happens. Year 10, you're going to be at over $6,000. Now, wouldn't that be nice to get $6,000 each year, each and every year for doing nothing? It's passive income. And when I say doing nothing, you're really not doing nothing. You're putting your time and your money into this. But it's not wage income, it's investment income. Let's go to 20. Year 20, you're going to be collecting almost $65,000 in passive income. You know what? If that doesn't get you excited, I don't know what does. So that's year 20. Year 25, look at that, 270. Whoa. And then year 30, 1.65. What is it? Year 29. Year 29, 1.1 million. So you're making more than $1 million a year those last couple of years. Year 28, you're only $754,000. So this is the beauty of the CAGR. Okay, it's a combination of your annual investment plus the dividend plus the growing dividend plus time. That's what you need. You're building that snowball. Yield on cost, well, to start, it's 3.44%, but look how it goes up. Let's go to year 10. Your yield on cost is all of a sudden 10.5%. So yield on cost, just remember, that is your annual income, dividend income, over what you've invested. So that yield on cost shows that your income is growing at a faster rate than your annual investment. What is it at year 20? 58%. Wow. Let's go to year 30. 1,066%. That gets me excited. That's a thing of beauty. This here is a summary. So again, your ending balance at 30 years is $6 million. Your total return, so it's your price appreciation plus your dividends, is 3,164%. Your average annual return for each year, 12.3%. But you're not just doing this for 1 year, you're doing it for 30 years, and that's where the compounding really takes hold. Your annual dividend income is $2,961,000. Your total dividend payments over 30 years, $5.5 million. Your yield on cost for the 30 years, 1,065%. And it makes a little more sense when you look at the table. Let's look at the table. You're starting out with 71 shares, all right, and you're going to get $2.40 a share. You're probably going to get a little bit more. I was thinking $2.56, but let's just go with this because this is the calculator. Your annual dividend that first year is $170. Your holdings are going to go up to $5,100. You're going to put another $6,000 in. So then all of a sudden, the number of shares you own is 156. Okay, your price goes up because remember, it's appreciating by 3% in the market. So you went from 71 to 72.63. Your new balance is $11,302. Next year, you're starting with that 155 shares owned. Your dividend per share goes up, all right? Because remember, they've got a CAGR of 12%. That's what we put into the model. So your annual dividend income goes up to $417. Your holdings have gone up to $11,663. You're putting another $6,000 in. You got 241 shares. Stock price goes up again, another 3%, $74.80. Your balance is now $18,000. Let's accelerate this. Let's go to year 10. You got 907 shares. Okay, you're going to get $6.65 a share in dividends because remember, you got a dividend yield of 3.4%. It's increasing by 12% a year. Your annual dividend now is $6,000. Your portfolio is up to almost $89,000. You're going to put another $6,000 in. You're going to have over 1,000 shares. The price has gone up to almost $95. Your new balance, $97,000. Let's go 10 years into the future. Year 20. Here, this is fantastic. You have over 3,100 shares. You're going to get almost $21 a share. I love this. Almost $65,000 in dividend income, just from dividend income, okay? You're going to go ahead, well, actually, before I put the $6,000 in, I'm getting excited here. Your portfolio is going to be worth almost $445,000. You're going to put another $6,000 in. You have 3,600 shares. Your stock price has gone up to $127,000. Your portfolio is now $465,000. Let's go to year 25. Look at this. From year 20 to year 25, the number of shares has gone up from 3,145 to 7,424. Okay, you've more than doubled it. You're going to get $36 a share in dividends. Your annual dividend income, passive income, $270,000. Okay, your portfolio is going to go up to $1.3 million. Put another $6 million or 6,000, excuse me, another $6,000 in. You got over 9,100 shares, almost 9,200 shares. Your stock price has gone up to $147. Your portfolio has gone up to $1.35 million. Let's go all the way to year 30, and hopefully you're getting ready to retire if you haven't retired already and living well. You're going to have, look at this. Year 25, you had 7,400 shares. Year 30, you're going to have 25,774 shares. You're going to get $64 per share in dividends. Okay, your annual dividend is going to be $1.65 million. Your portfolio is going to be worth almost more than $5.9 million. Maybe you throw another $6,000 in there. Maybe you don't at this point. But if you do, you're going to have over 35,000 shares in your portfolio. And your price of SCHD will be probably around $171. And your total balance will be over $6 million. You know, at some point you might say, listen, I don't want to put the $6,000 in. I want to live well. Or you might say, listen, this is for my kids. This is for my grandkids. I want them to, you know, have a nice nest egg that I can pass on to them. That's another way to look at it. But this way, what you're doing is you're doing a couple things. You're building financial independence. You're building wealth. You're really potentially building intergenerational wealth. And this is how it's done. If you can go ahead and start a company like Microsoft and become a gazillionaire, but if you're like most regular folks, you don't do that. You go to work, you do a job, you pay your bills, you save your money, and you invest. And this is how to do it. And it takes time. So this is really what I wanted to cover with you. And I tell you what, I would love to do more of these, and I'm going to do more. I have a few other investments where I'm going to take the same approach. And the purpose is, the objective is to demonstrate the power of dividend reinvesting, or the power of the drip. So I've done it with SCHD. I'm going to do it with a few others to drive that point home so you can see how wonderful this is. And I would ask if you could please, again, like the video, subscribe to the channel, Dividend Blasters, and share the video with a friend or a family member. And I wish you a wonderful evening. And to our next video, have a great day and God bless.